Hi, and welcome to Module 1.3 lecture on financial reporting. So hopefully you had a chance to go through and visit some company websites of some well-known multinational firms. And again, to look at the annual reports to sort of see how firms actually communicate what they're doing to shareholders or just folks who are interested in their financial data. So typically those annual reports that you would have seen would have a number of financial statements. And today's lecture is really going to talk about what those financial statements represent and how they're put together in general terms. All right, first let's talk about why we report financial reporting. Again, we typically go through our operating stages. We record transactions and then we report them to external and internal users of financial information. So our financial reports are really that means to communicate both inside and outside of an organization, to help folks understand what the status of our company is or our organization is, understand the types of activities that we've been engaged in, understand the things that we own and the things that we owe, and get a sense of what our overall financial picture looks like. Right. The information that's provided in these financial statements is necessary for decision makers, again, both inside and outside of the organization, and as well is required to be presented in comparable standard formats. We'll talk a little bit about those formats a little bit later, but it's important to understand that as you're looking at these statements, they all follow a very similar form set so that we can easily look at these financial reports, get the information that we need, and decipher them fairly quickly. All right. Typically, as you would have seen in your exploration of some of those major corporations, this communication in our financial reports is typically communicated on an annual basis or typically on a quarterly basis as well, but through our annual reports at least once a year, where we can make specific links to the company's strategies and their goals at the beginning of the year and the financial status of the company and how they actually ran the company to meet those goals. So there are typically four major reports that we'll be looking at. The first is what we call an income statement, and you'll note that all four of these are reported on a regular basis inside of our organizations, and oftentimes they'll help us to look at them independently and also as a whole. Each of them sort of depicts or tells the story of one piece of our company interactions. So our income statement starts by reporting our revenues and expenses for a given period of time. So typically we do this on a quarterly basis, so every 3 months. And then again we present one for an entire year. What we're really depicting here is all of the activities that generated revenues, all of our sales activities, and all of the expenses, all of the things that we had to pay out in order to generate that revenue over a period of time. And at the end of this statement we have what we call a net income. So how much money did we actually generate for the organization? The next is our statement of changes in equity, and what this tells us or communicates to users is how have the ownership status sort of changed? Have we issued new shares or brought new shareholders into our business? Have we paid our shareholders money? Have we paid out dividends to them out of our earnings? And how much have we sort of reinvested of our income? So did we reinvest some money inside of our organization? All right, and so we take that net income figure from our income statement, and that plays a role in our statement of changes in equities. That's going to be used to determine what we call our retained earnings. And retained earnings really is that how much have we sort of kept inside of our organization to do other things with. From there we'll move on to our statement of financial position. That's also known as a balance sheet for those who are familiar with the ASPE terms. But our statement of financial position really tells us what does our company look like? What things do we own? What things do we owe? And how much of our overall business has been provided to us through investors? So what does our shareholders' equity look like? And this is at a specific period of time, so the statement of financial position is really a snapshot at one particular date. What assets or what does the company own? What liabilities do they have or what do we owe? And what is our shareholders' equity? So how much have we retained from investors? or reinvested through retained earnings into our organization. All right. We're going to utilize the information from our statement of changes in equity to figure out, what that retained earnings figure is. So again, there's some interconnection between all three of these first statements. The last statement is one that we'll just touch briefly on today, but we'll actually spend more time on it later in the course, is our statement of cash flow. And our statement of cash flow is really a detailed statement that outlines one single asset, which is cash. We all know cash is king, so we have a statement that really just follows the flow of cash, both what cash comes in and how it was received over a period of time, and what it was used for, or how did it flow out. All right. So all of these statements combined sort of create the package of communication to users, and again, it'll help us to make decisions about the strength of a particular organization. Okay, so now what we'd like to do is sort of show you what these statements actually look like. And so I've created a bit of a jumble on purpose. We'll sort of piece this together, and this is our income statement. All right, so let's start with our income statement. We're always going to start our statements off with a title. Okay, and our title is quite simply our company name, so BCE Inc., and the name of our statement, so our income statement. The next part of our title is the period of time that we're looking at. So again, for an income statement, we're reporting transactions over a period of time. So all of these things didn't happen just today. They've happened over the past year, and they've kind of been accumulating over the year. And so we title it for the year ended December 31st. All right, next we're going to start with a subtitle, and we're always going to start with our sales, with our revenues. Okay, so we're going to start with what actually came in. What did we generate inside of our organization? We can classify our revenues in any number of ways. In this example, we have what we call sales, and we also have what we call sales revenues, or service revenues. My apologies. And so sales and service revenues, we could have this divided into different division categories, all of those different things. But what we've basically done here is had two separate types of revenues. All right, so we'll total those up on the side in this statement. And so if we tallied up our overall revenues, we would have had $100,000 of revenue. Next, we're going to list out our expenses. So it costs money to make money, as I'm sure we've all heard the old adage. And this is our chance to also show how much do we have to pay to operate. So what are the day-to-day expenses that we had to incur in order to keep our stores open, in order to have employees on hand to make sales or to generate service to our customers. And so we need to link our revenues with those expenses. And so in no particular order, and as we move through our course, we're going to talk about some of the standard form sets for these types of statements, and there are some rules in terms of how we present these different figures. But for now, let's just sort of walk through them. So we can list all of our expenses. So we may have things like advertising expense. We may have a rent expense, so we may have to pay rent on the sales office that we have. We may have a salaries expense, so we have to pay our employees to work for us. We may have interest expense if we have debt outstanding and we have to repay some interest. Right. And then we'll get a tally called profit before taxes. Okay, our profit before taxes is really our overall revenues minus our expenses. All right. And so again, we have a couple of subtitles here: revenues, expenses. We have a couple of subtotals. So subtotal for revenue. We'd have a subtotal for expenses. So if we tallied up all of our expenses, we'd have our expenses tallied up here to $20,800. Sorry. Let's try 40,800. And then we have our taxes before, profit before taxes. We separate our income tax expense from there. So again, we pay income tax on our net income. And then we'd have a line called our profit. And this is going to show us what did we generate for the year. So that's our income statement. So again, we start off with our titles. We start with our revenues, our expenses, to get a profit before taxes, and then our income tax expense. And then our final would be our profit. All right. And this profit figure down here, this is going to become an input to our next statement, which is our statement of changes in equity. Okay, so let's take a look at our statement of changes in equity. Again, we're going to start off with our title. Again, company name, the statement, and our time period. And our statement of changes in equity again talks about how did we issue any shares, did we bring any new investors on, did we redeem any shares or take investors out of our ownership mix, did we reinvest any earnings from our profit, so did we keep profit inside of the organization to do something else with it later down the road? Or did we pay money out to our investors through what we call dividends? And so this statement sort of follows that category. We have our common shares, retained earnings, and our total equity. Okay. So in our common shares, again, we're typically thinking about any issued or redeemed shares to our investors. In our retained earnings, we're thinking about anything that's been reinvested from earnings or profits. And our dividends, again, is that thing that we've paid money back to our investors. And so when we pay money out back to investors, it comes from our earnings. And so that goes under our retained earnings section. Okay. So we always start this off with our opening balance, or what we have in the company to start off with. And so if we're assuming that we started BCE today, just to make life simple, we'd have a balance in all of these categories of $0. Okay. If we issued any common shares, we'd list them in here. So if we brought any investors in, we would list them. So for example, let's assume that we issued $5,000 of shares. So we had a new investor come in and bring in $5,000 to join our organization. Okay. Again, we have our profit. So our profit came from our income statement, and we said that was $41,760. And so that gets added to our total equity. And then dividends. So out of the $41,760 in profit, how much did we pay out back to our investors? And that's this figure called dividends. So let's assume that we paid out $35,000. Okay. So now we're going to be able to get a balance for these three categories based on the information provided here. So let's take a look. Our common shares, again, we started off with no common shares. We issued shares to the first investors, And so now we have $5,000 worth of common shares. In retained earnings, we earned an income of $41,760, but we paid $35,000 of it out to our investors. And so really we've only retained $6,760 inside of the organization. And so the total equity, which is our common shares plus retained earnings, would be $11,760. And we can do that through adding up this column here or this column here to get our total equity. Okay, and this figure here, all of these figures are going to be used in our statement of financial position, which we'll look at next. So again, our statement of financial position, we always start with our title. So again, we have our company name, the statement that we're looking at, and then we have the date. Now there's one difference with the statement of financial position. As we said at the beginning, this is really a snapshot in time. So this is as of one date. What does the company own? What does the company owe? And how much have shareholders invested or have been reinvested? And so we'll start off by looking at what we call assets. And assets, again, is really what we own. So there's a number of different assets that could be listed here. So let's just list the ones that are here. So we have what we call cash, bank account balance, for example. We could have accounts receivable. These are customers who owe us money. We could have some equipment that we have on hand to do our work. We could have what we call prepaid expenses, or expenses that we've gone ahead and paid ahead of time. And so this is still kind of what we own because we can turn it back into cash if we needed to. For example, if we paid our rent for the next 2 years and 2 months later decided we were going to cancel it, we'd likely get a portion of that back. And so we consider that a prepaid expense, and it can be considered an asset, or we own part of it. Okay. And then we'll get what we call our total assets. So we'll add those all together and get our total assets. Next, we'll look at our liabilities. And our liabilities are really what we owe. Okay. And so we could have some interest that we have to pay to the bank for a loan. We may have to pay our taxes. We haven't paid the government yet, and so we have a tax payable. We may have a bank loan that we owe money on. All right. And then we'll get what we call our total liabilities. So we'll just tally those up here. There we go. We'll also add our shareholders' equity. So again, this is considered what we've invested or reinvested in the company. And again, similar to our statement of changes in equity, you'll see the categories are very similar. We have our common shares. And again, we get that figure from our statement of changes in equity, $5,000 in common shares. We have our retained earnings. And again, very similarly, we get that from our statement of changes in equity. And we have our total equity. Okay, I'm just going to put a line here to show that this is mathematical additions. Then what we'll do is we're going to add those up together. So our total liabilities and shareholders' equity. Okay. And you'll note here, and we'll discuss this in a later chapter, but what we're looking at here is if we looked at this as sort of a scale, so if we balanced out this scale, the other name for this statement is called a balance sheet. And so what we're really trying to do is balance the scale here, and what you'll see is that our total assets is always equal to our total liabilities and shareholders' equity. In other words, what we own comes from either borrowing, what we owe, or from what's been invested or reinvested. So what we've been able to generate in profits in order for us to buy new assets or to have cash on hand, or funds that have come in from investors. So we had someone invest $5,000, we could go out and buy a portion of the equipment, or what we owe. So we borrowed money perhaps to buy our equipment or something like this. Okay, so what we'll see is that our statement of financial position is always in balance. Okay, but what's most important at this point is just understanding what the formats and some of the inclusions in it. Okay, so let's do a brief exercise here just to ensure that we sort of understand this concept. So let's look at the following list of accounts, and all we want to do right now is identify what statement we would see this category on. Either the income statement, statement of changes in equity, or the statement of financial position. So if we think back to those three examples, we saw this thing called cash. And we saw that under the asset category of our statement of financial position. If we thought about our profit, we saw that in our income statement. That was the output of our income statement. Remember, we had our revenues minus our expenses equals our profit. The profit also factored into our statement of changes in equity. Because you recall, we added our profit to our retained earnings. Service revenue was found on our income statement. Accounts receivable was found on our statement of financial position. Bank loan payable was one of those liabilities under our statement of financial position. Retained earnings, remember we saw that category on our statement of changes in equity. We also saw it listed on our statement of financial position under our shareholders' equity section. Okay, common shares, we saw those under our statement of changes in equity. Remember, we tracked if we had issued or redeemed any shares. As well, we showed that on our statement of financial position underneath the shareholders' equity section. Equipment we saw on our statement of financial position as an asset. And salaries expense was one of those expenses under our income statement. All right. So at the end of this module, what we're really hoping is that you can identify the three income statements that were presented here: income statement, statement of changes in equity, and statement of financial position. That you're able to understand some of the categories that are included in each of those statements and what their main purpose is, or what they're trying to communicate to users of financial statements or financial information. So we would understand that our income statement is showing us the end result of our operations, so our revenues minus our expenses. Our changes in equity is tracking what's changed in our equity position. Have we issued new shares and brought money in that way? Have we redeemed shares? Have we paid our shareholders a dividend? Or have we reinvested our profit in our retained earnings? And last but not least, our statement of financial position, which was that snapshot to show us our overall financial health, our assets, our liabilities, and our shareholders' equity. Okay. So at this point, please feel free to work through the self-assessments for this module. And as we continue in the rest of Module 1 and into Module 2, you'll start to see that these statements become a bit more comparable, and we'll talk about some of the different elements that are inside of those statements. Right now, what's really important is that you understand what they look like, what they communicate, and some of the different titles that are on them. All right? Thanks so much, and good luck with the next modules.